now.
Good afternoon, everyone. This is Rebecca Robinson. I am the Director of Enterprise Wealth Management for Zions Bancorp. We want to thank you for joining our ongoing series of webinars to discuss the impact the coronavirus has had on the economy and our financial markets and how to navigate market volatility during this time. Today, we're going to have Anthony Valeri, our Chief Investment Officer, provide commentary on recent market actions and what to expect going forward. Then we'll be joined by Chris Considine, our Director of Wealth Planning, to talk about the new tax filing deadlines and previous legislation that has passed, with also some brief commentary on the Senate agreement that came down late last night. Finally, Chris will share some planning advice we'd like all of our clients to hear on things they can be doing during these very difficult times. So things like continued market volatility, including yesterday's significant market increase, the Senate agreement promising $2 trillion of governmental stimulus, as well as guidance on legislation passed 2 weeks ago, will all give rise to today's webinar. So with that, Anthony, I'm going to hand it over to you.
Okay, thanks very much, Rebecca, and thank you everyone for taking time to listen in on our webinar here. We really appreciate it, and we will continue to do our utmost to keep you advised through this difficult market period. Let's go ahead and get started with some of our key talking points. And first and foremost, I would say brace yourselves for some very weak economic data in the weeks ahead. A lot of this is a result of the shelter in place and similar restrictions. A recession at this point is likely, unfortunately. I think most people are aware of that, but given what's transpired in the last couple of weeks, I think it's become very much a reality. That will start shortly tomorrow. I'll talk more about that. The good news is that stock prices already reflect a recession. I mean, a lot of that, the decline happens in anticipation of a difficult period, and this decline in the stock market, as we've mentioned before, the quickest move to a bear market in history. Stock valuations now, particularly relative to bonds, are in attractive territory. And the Fed has been very aggressive, more so than during the 2008 financial crisis, in providing key support for the market. We just mentioned this, Congress working on a stimulus bill. It got this slide approved by our compliance just ahead of the final vote, but it has been approved for $2 trillion. And as we've mentioned in the past, we believe that bottoming is a process, and it takes time, sometimes a few weeks to a few months, and we'll talk about that as well. We still think that is the case, even though we do see value now, so it requires patience and staying to a disciplined investment strategies. And then lastly, we'll talk about some of the signposts we're looking for as to ultimately what will signal more of a market bottom and stabilization. So why don't we move forward to the economic data? I had mentioned to brace yourselves for some weak data. Starting tomorrow would probably be one of the bigger numbers, and we actually had one this week on the Purchasing Managers Index on the service side of the economy, which showed very weak numbers. But tomorrow's probably the biggie with weekly jobless claims. Thursday, March 26, we should see a significant increase. This is weekly jobless claims data. It started to increase last week, but tomorrow's number, Thursday's number, should exceed the peak witnessed during the 2008 financial crisis. And again, that's simply reflective of these shutdowns and quarantines, these restrictions really hitting the service sector, the travel and leisure industry particularly hard. So look for a big number there. Could exceed 1 million jobless claims. Again, market I think knows this to a large degree, but be prepared as more of this comes through in terms of negative headlines. Similarly, second quarter economic growth expected to be very weak. Here's a sampling of some of the more negative reports out there. The consensus is for a 7% decline, but updated forecasts are still coming in. They're going to be weaker. I think that consensus probably moves more towards -10, maybe a little weaker than that. But you can see a variety of banks and economic shops and their forecasts here for the second quarter. These are some pretty big and negative numbers, especially during 2008. The biggest decline was just over 7%. You can see the most negative there is Morgan Stanley at just down over 30.1%. I don't know how they get to the 0.1%. I think -30 is bad enough, but so be it. That's how we get these forecasts. But anyway, some bad data coming. Be advised. Again, I think the market has largely factored this in and anticipating it, but it will still create a bit of a headwind as we move forward. I mentioned the Fed and their response being greater than 2008. This is a list of just some of the actions they've taken and I'll run through them quickly, and it's certainly not all-inclusive. It's really been a very aggressive response, and it's been a response that happened really in a series of about 10 days, starting with not this past Sunday, the prior Sunday's cut of 1% to the overnight lending rate down to basically zero rates again, a restart of bond purchases and removing the limit to those purchases. The Fed's on pace now to buy nearly $1 trillion in mortgage-backed securities and over $1 trillion in Treasury securities in a single month. They increased the repo market liquidity to the highest ever. Dollar swap lines with foreign central banks to ease funding pressures, lowered the discount rate to ease banks and their needs for borrowing, and then a number of facilities, without getting into details, that just help functioning in financial markets, which had really come under stress last week. And you're starting to see some of the benefits of those in financial markets. Talk more about that in a moment. And then a credit facility to help corporations, and then asset-backed securities as well to support consumer and business financing. So a lot of these are resurrection of 2008 crisis area type measures, but all in, the Fed's been very aggressive to support markets and to a lesser degree corporates as well with their borrowing needs. So a big response from the Fed. I think you need to see that in this environment. It's one of our signposts that we look for improvement. And one way you're starting to see that is in, I mentioned the financial markets. LQD is an ETF tracking high quality investment grade corporate bonds. Saw a sharp decline there, and you typically see some weakness in investment grade corporates with the prospects of recession rising. But really what drove this was poor liquidity and the markets being overwhelmed with sell orders, as last week saw a bit of a sell what you can mentality. And that panicky type of ordering, that selling, can really pressure particularly some ETFs down further than fundamentals or intrinsic value would imply. And I think once the Fed stepped in, you saw a pretty sharp bounce back here in just a matter of a couple days. So you're starting to see that translate through to the financial markets, not just LQD, but other ETFs as well that might have been hit or squeezed with liquidity issues. And in terms of the 10-year Treasury yield, yes, even the Treasury market saw some volatility because of those liquidity issues in that sell what you can environment. And now we've seen Treasury yields stabilize, come back down, and I think we'll see Treasury yields stay very low for the foreseeable future. So just some signs on how the Fed's medicine is slowly starting to leak through to the financial markets, which I think is a positive and helps set the floor for this market. Now moving to stocks, let's move to valuations, which, as we discussed before, were attractive. They've got more attractive after a difficult week, and this is the price to earnings ratio on the S&P 500 going all the way back to 1980. The higher the PE ratio, the more expensive stocks are, and vice versa. The lower the PE, the more attractive the valuation. The current PE ratio on last year's earnings is 13.5, and the only time it's been cheaper, it's been brief, but in 2011, you can certainly see in 2008 and early 2009 during the financial crisis. Before that, you have to go back to the 1990 recession to see similar type valuation levels. So we've certainly got cheap valuations. If you're a long-term investor, we don't know what the ultimate bottom is. Maybe we saw it earlier this week, maybe it's forthcoming, but from a long-term perspective, this is an attractive valuation, and it's particularly attractive relative to bonds. As we look at, when we compare stocks versus bonds, one of the more popular models is using what we call the Fed model, which simply compares the earnings of the stock market, and you basically take profits per share and divide that by the index price, and you get sort of what we call an earnings yield, and subtract from that the 10-year Treasury yield. It's a way to compensate stock valuations or measure stock valuations relative to bonds. So the higher that yield is relative to bonds, the more attractive stocks are, and vice versa. You see that here on this chart. You can see this in 2008, that this, what we call this, actually the full name for this is the equity risk premium. It's how much are you being compensated for owning stocks relative to bonds. That premium spiked to 6% in 2008. In 2011 and again, in 2012, it briefly spiked 6% again, and now we're back at that 6% level. So from a perspective of being attractive relative to bonds, this is about as good as it gets. So again, if you're a long-term investor, attractive entry point into equities, and certainly for a number of investors, we are rebalancing to take advantage of those more attractive valuations. So where do we stand in terms of the process of the sell-off? Again, I think it's going to be a few weeks to maybe a few months, but there are some incremental positives happening when you look under the hood of recent trading. One is, are investors coming back into the market to take risk? And there's various ways to measure that. One is to compare two sectors within the stock market, consumer discretionary versus consumer staples. Discretionary, as the name implies, more discretionary items, whereas staples are your must-haves. This chart, the rising line here means that consumer discretionary is outperforming consumer staples and vice versa. And you can see from late February through the middle of March, consumer staples had outperformed, but this bounce back shows that it's the first tangible sign that maybe selling pressure has exhausted itself and that there is a return, there is some risk seeking coming back into the market. Another sign that is an incremental positive is, and shows that selling pressure is abating, is charting the percentage of S&P 500 stocks that have made new 52-week lows. That number peaked twice. One was last Monday, and then actually in the prior week as well. But that since, the number of new lows has been slowly decreasing. The rise you see there is on Monday's decline in the equity market, but that lower trend is an encouraging sign, one that we like to see. And I don't want to make too much of these. This is just a start. There are other components to engineer a turnaround, but to start to see some of these metrics now is encouraging and ultimately helps the market put in a bottom. And as we look back on historic bear markets, I've used this one before. This is the typical amount of time that a bear market will last, and then what the average decline is. This is through Tuesday. Yesterday's data down 28%. If had I taken this on Monday, that would have been minus 34% for the current bear market, which is slightly in excess of the average decline. So we've experienced a very not only the sharpest decline, but a decline that has already exceeded the average of a typical bear market. That's not to say it couldn't go lower, but hopefully it provides some context on just how severe this pullback already is. Now let's move to another one of sentiment reading quickly that I think is worth noting. Just got data yesterday on the institutional investor survey of whether folks are bears or bulls. There's a couple of surveys out there that ask investors, are you bearish or bullish on the market? One is the American Association of Individual Investors, which we're not showing here. This is more the institutional investor level, and this one finally got to a point where bearish investors exceeded bullish investors. Percent bearish was 42% for the coming in the most recent reading. And the significance of this is that when you have enough of this negative sentiment, you do get a point where it sets up for a rebound in the market. And you can see here the 6 and 12 months returns after that sentiment had reached its threshold of exceeding the amount of investors that are bullish. So this sort of negative reading is a good one to indicate a potential turnaround. And the timing is, near-term timing is tough to be spot on. But again, if you have a longer-term horizon, 6 months, 12 months, historically, this has been a good sign. Now let me take a longer-term view on what happens to stocks during a recession. Again, I had mentioned it's likely we're in a recession. March is likely going to be the start of that, given the data we're seeing and the ongoing presence of shutdowns. Here is the S&P 500 during the 2007-2009 recession. The recession didn't end until June of 2009, and unfortunately we don't know until after the fact when it ends, but it just goes to show you that when it bottoms before the end of a recession. Here, this was March of 2009. I also want to show that there were multiple bottoms along the way. There were a few spots where October 2008 witnessed obviously a sharp decline, a minimal bounce back before bottoming again in December of 2008 before a brief rally and then subsequent loss again. So as I mentioned before, some of these bottoms take time, and more importantly, the stock market reverses ahead of the end of a recession. So important to realize that the stock market is a forward-looking mechanism, and we do get a lot of questions on when do I get back in, should I add money? Well, it's really hard to time that, but be aware that by the time you get the all clear that a recession is over, the stock market will likely have moved on ahead of that. Let's take a look at another recession. This is the 2001 recession, which was preceded by the dot-com and telecom bust, so a little different experience. Showing two things here. Once the market trying to bottom in April of 01, the recession started in March, and then bottoming firmly in October, again about a couple months ahead of the end of the recession. So showing that there is a false or bear market rally before it ultimately bottoms completely. Again, this is this particular environment, 2000, 2001, 2002, with the September 11 attacks, I think a different environment, but goes to show you that the stock market still rebounds before the end of the recession. And then if we go back to 1990, this is an interesting one in the case where, yes, there was sort of a multiple bottoming process, but stocks bottomed almost a good 6 months ahead of the end of the recession. And if you put that in context to today, if you think the recession started in March, which I think it probably did, and if it lasts through the end of the third quarter, call it September or October, we could, if it's 3 months beforehand, that puts you at about a June time frame. Again, if it's shorter compared to this 1990 type of incident, it could be earlier than that. So again, it's really hard to time, but it's just important to know that stocks can bounce well, certainly ahead of the recession, and in the case of 1990, very much ahead of the end of the recession. And just a couple more charts to support this. If I shift to high yield bonds in 2008 during the financial crisis, high yield bonds also bottomed ahead of probably almost at the peak of negative sentiment. In December of 08, the average yield advantage to treasuries reached almost 20 percentage points. And although stocks bottomed in March of 09, the high yield market was the first to stabilize and kind of give the early indication that things were improving. So when you look at financial markets in general, it's tough to time. They will improve before a lot of the data begins to improve as well. And I thought it worth mentioning that a couple non-recessionary periods and how those worked out. 2015 and 16, again, it took a while for a bottom to form. Sell-off, started in August of 2015, and it wasn't until January, February of 2016 that the market ultimately found a bottom. This was a combination of the Chinese currency devaluation in the summer, followed by oil sector troubles, and then a similar situation in 2011. Sell-off started in late July, early August 2011 with the U.S. downgrade, and then ultimately with a strong policy response in October of that year did stocks rebound. So again, bottoming is a process, important to keep that in mind. And then just to take a shift to the virus itself, one of our signposts that we're looking at is to chart when there is a slowdown in cases, and this is the growth in cases for a variety of countries in terms of days since the 100th case was announced. You can see the red line, which is China, but the dark blue line is the United States. That pink line is Spain. The U.S. is seeing some of the fastest acceleration here in cases, and I think that is going to provide a headwind. Ultimately, we need to get the number of cases under control for more confidence to return to financial markets, and that is still elusive. So we'll keep tracking this as well. On a positive note, the number of cases in Italy, they're still increasing, but that rate of growth now is in the single digits. So those lockdowns finally having an impact in Italy, and I think that's an encouraging sign as we try to look towards the end of this virus and its effect on society. So we'll continue to track that, but this growth of virus is still somewhat elusive. And then a few charts on just investing and long-term thoughts really on how you should view the markets. When you look at annualized returns in the equity markets, 70% of the time, actually 73, and this is the top chart here, markets finish with a gain. So for the most part, the odds are in your favor for positive returns at investing for the future. 27% of years going back to 1926 were negative. If you go to the second set of bar charts there, that's a 5-year horizon, and your odds of success improve over time. So over a 5-year period, almost 90% positive gains, and then over a 15-year period, the bottom chart, every single period has been positive for equity investors. And I thought I'd include, if we look back at prior downdrafts in the market, prior crises, if you will, you look at 1987 and the crash, the Gulf War, the Asian crisis of 1998, tech bubble, financial crisis, the U.S. credit downgrade in 2011, and then recently the trade war. You can see the decline in U.S. stocks over those periods, and then you can see the subsequent bounce back, which is very strong. Should say that, and again, this is just 12-month bounce back. So in the case of the financial crisis, although stocks were up 68% in that following 12 months, that didn't recoup all of the losses from that crisis, but it shows you the strength of the rebound just simply in the next 12 months. And of course, in all of those cases, stocks continued to move higher. So important to have that perspective that historically stocks have bounced back from severe downdrafts, and important to have that longer term perspective. Also to remember that if you miss out on some of the best days in the market, your returns will weaken over time. And here is the period January 1995 through March 15, 2020, the last just over 25 years here, roughly 25 years, and you'll see that if you're fully invested, that's a 7.3% annualized return, but as you miss even just 5 best days, those returns start to decrease, and as you go to the right, you'll see them missing out on more and more of those bigger up days. Has a really detrimental impact on long-term performance. So be careful with trying to time the market. We certainly don't advise it. We recommend staying with a disciplined investment approach, and we are certainly encourage folks to rebalancing, which we're helping many clients do that right now. And then let me shift before I turn it over to Chris on some of our signposts that we are looking for a potential turnaround. So one is cheaper valuations in the stock market. Trailing PE ratio is 13.5, so we've definitely achieved cheaper valuations, so check that off the list. Peak negative sentiment, that's been achieved as well. There are multiple indicators showing the peak fear in the market. It doesn't necessarily bounce back right away, but that's a first checkpoint to see when the worst of the declines are behind us and the market begins to bottom. We've seen aggressive action from the Fed, fiscal stimulus, both the U.S. and abroad. We have it in the U.S. announced last night, and that is a big positive. You'd likely to see about a similar stimulus in terms of size of the economy from Germany as well, and then signs of the virus case slowing, and we're not seeing that yet. That is one that is missing. Again, I mentioned how the number of cases is slowing in Italy, so we'll keep an eye on all of these, but again, we're getting closer to, I think, an ultimate bottom is in the market. Chris, a number of positives from the fiscal stimulus bill. I know planning issues that you'll talk about as well. I think that'll also stimulus certainly help investors, but let me turn it over to you here for more on the planning side.
Great. Thank you, Anthony. Really great information there. Hopefully everybody will continue to tune in to these webinars, because I think Anthony's just doing a fantastic job of keeping everybody apprised of the breaking information in regards to markets. I want to talk a little bit today about some of the tax news that has come down really in the last 48 hours. Also, we're going to get to some specific planning advice that we've got for clients. But let's jump right into some of the latest tax and legislation news that's out there. So yesterday, the U.S. Treasury Department, Internal Revenue Service, and the U.S. Department of Labor announced that small and mid-sized employers can begin taking advantage of 2 non-refundable payroll tax credits designed to immediately and fully reimburse them dollar for dollar for the cost of providing coronavirus-related leave to their employees. This relief to employees and small and mid-sized businesses is provided under the Families First Coronavirus Response Act signed by President Trump all of 1 week ago, but it seems like a month ago to say the least. The credits are going to give businesses with fewer than 500 employees funds to provide coronavirus-related paid leave, either for an employee's own health needs or to care for family members. Under the Act, employees receive up to 80 hours of paid sick leave for coronavirus-related reasons and expanded paid childcare leave when schools are closed or childcare providers are unavailable. To take immediate advantage of the paid leave credits, employers can retain and access funds that they would otherwise pay to the IRS in payroll taxes. If those amounts are not sufficient to cover the cost of paid leave, employers can seek an expedited advance from the IRS by submitting a streamlined claim form that will be released very soon. Also, yesterday, in Notice 2020-18, the IRS provided guidance on some guidance made in regards to the announcement last Friday, which again feels like forever ago, to the extension of the tax filing deadline from April 15th to July 15th. Key points from this guidance include any person with a federal income tax return or payment due on April 15th, 2020 is eligible for relief under the notice. Person includes any type of taxpayer, such as an individual, a trust, an estate, a corporation, or any type of unincorporated business entity. The payment due refers to both 2019 federal income tax payments, including payments of tax on self-employment income, and 2020 estimated federal income tax payments, including payments of tax on self-employment income, regardless of the amount owed. So originally it was you were able to exclude up to $1 million. Anything above and beyond that was still going to be payable on April 15th. That is no longer the case. It is on any amount owed. The return or payment must be due on April 15th, 2020. This relief does not apply to federal income tax returns and payments due on any other date. So this extension does not apply to the filing of gift or estate tax returns. Also, in regards to estimated tax payments, first quarter 2020 estimated income tax payments are postponed from April 15th to July 15th, 2020. Curiously, I'm not sure why they did this. Curiously, second quarter estimated tax payments are still going to be due June 15th, 2020, which means you'll be paying your second quarter before you'll actually have to pay the first quarter, which is July 15th. Also, another important piece for some of our clients out there is contributions can be made to your IRA for a particular year at any time during the year or by the due date for filing your return for that year. Because the due date for filing federal income tax returns has been postponed to July 15th, the deadline for making contributions to your IRA for 2019 is also extended to July 15th, 2020. So for practical purposes, if you would like to still make a contribution to an IRA, you could make it on July 14th of 2020 for the 2019 filing period. I will point out this relief applies only to federal income tax payments. State filing and payment deadlines vary and are not always the same as the federal filing and payment deadline. So we urge you to check with your state tax agencies for those details. Now, a couple of notes about the agreement that was passed by the Senate last night. And I know there's still some arguing going on. Hopefully that it gets abated. They're still planning on trying to have a final vote on this by this evening. Hopefully by the time everybody hears this, it will be done and it will be passed. But the legislation is expected to sail through the House and be signed by the President at some point, perhaps by next week. It's definitely an evolving situation, but we do believe that we're going to have this stimulus, and it's going to be a much needed boost to also help out the Fed, as Anthony was explaining, with all that they're doing. The legislation right now is a $2 trillion rescue package aimed at combating, obviously, the coronavirus pandemic across the country. The government, it will send checks directly to taxpayers. For those with incomes below $75,000 per year, each taxpayer will receive a check for $1,200. Families will receive an additional $500 for each child in the family. The $1,200 per taxpayer will be phased out as income rises above the $75,000 mark, and it's going to be eliminated entirely for those with income above $99,000. Unemployment benefits will also be expanded, both in benefits and in who qualifies. There's going to be an additional 13 weeks of jobless insurance in the legislation, as well as the inclusion of a 4-month enhancement of those benefits. Now, I asterisk that because at this point in time, we don't have enough details to understand exactly what those enhanced benefits entail. So we'll have to just wait, and on a subsequent call we'll tell you what those are. Also, unemployment benefits are now available for freelance workers, so furloughed employees, gig workers such as Lyft or Uber drivers. There's also some provisions in the bill that includes the creation of a federally guaranteed loans program, which is going to be available via community banks to small businesses that pledge not to lay off their workers. These loans will be available during an emergency period ending June 30th and will be forgiven if the employer continues to pay workers for the duration of the crisis. Loans for distressed companies would come from a $425 billion fund controlled by the Federal Reserve, with an additional $75 billion available for industry-specific loans, including airlines and hotels. Finally, the agreement includes $100 billion for hospitals and healthcare systems. For a piece of legislation this size, there's obviously much more in the details, and we will share those with you as we learn them. But now I'd like to turn to some planning-specific ideas that we have for our clientele. It's a time of uncertainty, certainly, and we want to make sure that all of you are feeling as empowered as possible, and we think there's still some things that everybody out there should be considering. The first one is, let's take advantage of the federal and state income tax deadline extensions. Obviously, unless you're anticipating a refund, now that you've been able to extend out to July 15th, that's an important piece for a lot of our clients. I will note that one of the things that we'd recommend to clients, however, is a problem. If you are expecting to receive a check from this, one of the problems is just the simple logistics that the federal government has for being able to send out some of these checks. Physical checks could take up to 4 months. If you have been filing online and have in there for direct deposit into your bank account, that's going to make your check be able to come to you, they think, within about 3 to 4 weeks of the legislation finally being filed. So if you think that you're going to be eligible for these types of benefits, we'd recommend that you perhaps file your taxes so that you can include in there where you would like those funds to be deposited. Obviously, if you owe on those, you do not have to pay that until July 15th, but it might be a good idea to get in line so that you can be able to receive these payments. The second big one that I wanted to go over is we really need to prepare for the possibility of incapacity due to illness. We'd recommend to all clients that they locate their medical powers of attorneys, their advance directives, their HIPAA authorizations. Ensure that the named agents and healthcare providers that you have put on those documents also have copies of this. If you have some named agents who don't know that they've been named in your documents, now's the time to let them know. And obviously to get them a copy of this so that they can help deal with whoever they need to on your behalf. If you don't have these documents in place, most of them are statutory and can be downloaded on state or healthcare provider websites. Also, we'd recommend locating your durable power of attorney. Again, this is typically a statutory document that you can download from a state website. The durable power of attorney authorizes an individual to make financial decisions for you. The medical power of attorney authorizes somebody to be able to make medical decisions in the case of your incapacity. Also, consider adding a spouse as a joint owner on any individual accounts you have. If you have a prolonged period of incapacity, or if you do pass away, it would probably be very beneficial for your spouse to be able to access funds in order to be able to help in this interim period. Finally, you could transfer assets such as homes, investment accounts to a revocable trust. If you have one of those, it's going to make probating your estate much, much easier if you do pass away. Some other practical issues that we'd really recommend clients start thinking about if they don't already have in place. And the first one is just maintaining sufficient liquidity to cover 3 to 6 months of living expenses. If your monthly expenses are unknown, now's a good time to calculate and refine that budget. If you're in a city that's a shelter in place like Anthony and I are, you have a little bit of time hopefully to be able to pull out that budget, dust it off, and look and see what some of those expenditures are going towards, and be able to refine it. I think it will help in alleviating some concerns if you know that you've got 3 to 6 months covered. Just as in the same way that we are obviously recommending to parents and other individuals to stock up on foods, don't overstock, but just stock up on it so that you can cover yourself in an interim period. We'd like for you to do the same thing with at least 3 to 6 months of living expenses held in cash. Also, begin proactively saving cash from reduced spending categories due to social distancing. I know for myself, there's no more dining out. I haven't been driving nearly as much. Hopefully that will free up some cash for myself. Hopefully you'll be able to do the same thing, and you can use that to fulfill that short-term bucket. Finally, it goes without saying, you probably want to consider deferring any discretionary major expenses such as new cars or kitchen renovations until we actually get through this. And then just to dovetail off of what Anthony has been talking about, we want to make sure that you're ensuring your asset allocation aligns with your goals, your time horizon, and risk tolerance. Revisit those goals and adjust investment strategy only if the goals have changed, not based on daily market movements. All of the volatility that we've been seeing, as Anthony has described for us, it's likely to start to peter out at some point in time. And that's when we want to be making some changes. That doesn't mean that we don't want to rebalance your portfolio to realign with your strategy, be able to take advantage of that. But we don't believe it's in your best interest to completely change how you've invested to this point based on just daily market movements. Rather do it in a rebalancing way so that you can realign your strategy with the goals that you've got. So with that, I'd like to turn it back over to Anthony for some final thoughts.
All right, Chris, thanks very much, and thank you all for taking the time today. Please stay with us as we continue to provide updates on the markets and their potential impact, market volatility. We will stay with you. Keep an eye out for client letters as well to keep you updated as on the written word that we send out, but we'll look forward to speaking to you again very soon. Thank you.